All right, it's June 10, 2022, and you're watching me, Nikki, also known as Awesome 10X, for the Global Market Free Friday class. Let us begin. All right, let me share my screens now. And for those who are new to the channel, please like and subscribe. Thanks for watching, and let's begin. Okay, we entitled today's post as Billionaires taking breaks, cash on the sidelines, market bearishness continues. Let me give you just a preview of the most important news that I think you should know about. Of course, tonight, yes, we've got the inflation report that would impact what the Fed will do on June 14 to 15 on their meeting. Although the market widely is bearish, noting that inflation is taking a toll on everyone and it would mean further aggressive rate hikes within the next few months. So investors currently are being extra cautious, and in current times of volatility and inflationary environment, a lot of people are cutting towards cash, trimming exposures to a very little amount or a small amount so that whatever transpires, whether it be a big drop or not really a big drop, but actually a big rally, the market is actually still aware that any rally will still be sold. So there's definitely a lot of people caught either short covering or just really staying in the sidelines. Now let's read through a few news that are a few things important for the rest of the next few weeks. We all know China has been a large importer of oil and agricultural products. Now, this might be something that you might be surprised. You might think that China does not import oil. China imports oil from Russia and a lot of agricultural products as well. Though Xi Jinping has always cast himself as a champion of green causes, he has also made concessions on China's carbon goals, calling for realistic approaches, encouraging coal production as a buffer against soaring oil prices. So far, about coal, a lot of that comes from Indonesia. So he talked about importance of food security, self-sufficiency, the rice bowl of the Chinese people must be filled with Chinese grain. You could see that a few months ago, the Chinese government has been very silent about the stock market, saying that they need to appease small businesses and the lower middle class, which prioritize a lot of tax cuts, rebates, EV subsidies, and amounts doubling from last year to as much as $400 billion. And they also agreed to build 6.5 million low cost rental apartments by 2025 to appease the 300 million migrant workers. This comes after massive economic fallouts from the Evergrande, a $300 billion default. And as you know, China's economic crisis causing those COVID zero policy lockdowns, which weren't really as good as expected. You've had months of lockdowns triggering supply chain problems. And so far, we're also seeing, of course, amongst the easiest targets to just pin down, easier to just sell off all the cryptocurrency related stocks listed in the market. You're seeing this crypto focused bank Silvergate in a huge sell off. You're seeing that 2 year low here about $60, really a thin ice. And if it breaks, it's all the way down to $20. We do have a call to short Silvergate, and it seems as if this rally for the last few days is typical of a bear market rally, which is similar to what happened here from about January all the way to May. That was a 5 month sell off from about 170 to 120. Although 80 towards 60 is possible with a lot of supporters at 60, we could argue that the downtrend still remains in place. Let's just go through the charts first. MicroStrategy is still in a huge downtrend here. You're seeing all crypto related stocks as an easy target with the market relatively still on the large bearish notes, no? So you're seeing that cryptocurrency still has leeway to fall another 50%. You're seeing the next support of MicroStrategy around 150 to about $90. If you're looking to trim positions to cash or short the markets, a lot of people continue to be shorting MSTR, Silvergate, and Coinbase. So Coinbase has been a huge downfall, about 80% down. However, even at $64, with majority of the market actually not deploying cash towards any crypto investments, and with a lot of competition with Coinbase, you've got IBKR and Charles Schwab preparing all of their crypto platforms and mass for their clientele. You're seeing a huge moat getting crushed in Coinbase, and you're just seeing more downtrends here. A lot of sellers continue to remain a seller, and with very little liquidity now, for it to drop back to $40 or even $25 is a matter of earnings, which comes next 3 months. Okay, last night you're seeing a lot of volatility, a huge rug pull towards stock markets, even in the amidst China. Although nowadays the Chinese losses have been paired in Hong Kong, so we could sense a huge volatility happening in China. Last night, your Tao, Tal, Yotao, Tal, Miniso, Bilibili, Edu, KC, Best, Yin, Pintuoto, Huya, Agora, Alibaba, Yum China, Neo, JD, Doyu, Dada, Becky, all dropping Momo 6 to 18%, all in a single day after consecutive days of rally. Now in China, you'll see that what you would have thought in Hong Kong to be a follow through, you did have a gap down only to close majority near the highs of the day. So you're still seeing a ton of volatility in the market, but the rallies were actually just around 1 to 2%, signaling that the market is still highly cautious. And the only reason why it managed to stay unchanged was because it gapped down in the market morning in the first place. So nowadays you also have in the after hours DocuSign shares dropping 25% after first quarter earnings came in short of expectations. So the massive drops after earnings aren't over. You've seen how this happened in Roblox, in Unity, in Snapchat, and nowadays you're seeing it in DocuSign, Stitch Fix. So a lot of layoffs are continuing to happen. A lot of CEOs are continuing to have super bad feelings about the economy, not just Elon Musk. Jamie Dimon talking about an economic hurricane. So the backdrop is very negative. As you can see, even on April 21, a lot of people are talking about the Fed hikes, pandemic death piles, adding to the risk, not just for US, while all the other developing nations or emerging markets are also sliding into hunger and blackouts, an emerging economic crisis similar to 1997. So let me just read to you a few of these things. Turmoil triggered by rising food and energy prices is gripping countries like Sri Lanka, Egypt, Tunisia, and Peru, risking into a broader debt debacle and yet another threat to the world economy's fragile recovery from the pandemic. Right now, the Philippine peso is already trading at dollar peso of about 53 above. And we're really seeing that this huge dollar strength is very negative. Obviously, that dollar strength might be pinned down from further rate hikes this year, which would need the Philippine market to also hit higher interest rate spikes, which is going to be very difficult for everyone who is borrowing debt, assuming that that debt is 5 years or 10 years and really getting higher interest rate expenses. So the danger, of course, is that this aggressive monetary tightening campaign by the Federal Reserve is going to be a huge difficulty for debt servicing costs for all developing nations right after they all borrowed billions to just to fight the COVID-19. On top of it, the war in Europe, driving all the food and energy shock, shows few signs of ending. I think just now, Putin was, like a few hours ago, there was an interview on Putin saying that you cannot just trap me in my fence, suggesting that Russia obviously is not backing down, and this war is obviously not ending anytime soon. Cocktail of risk has already pushed Sri Lanka to the brink of default on its bonds. A handful of other emerging economies, Pakistan, Tunisia, Ethiopia, Ghana, are in immediate danger of following suit. So exporters stand to benefit from higher prices. Yup, you've got countries like Australia, Indonesia, Canada, a few countries benefiting, but other than that, a majority of the developing nations are really having a hard time. Lockdowns. China just reopened Shanghai, but a few days ago they're starting to have massive COVID testings yet again, which means that they might actually close it yet again. So another bad news. Growing angst in Europe, U.S. falling to recession. So you've got a pile of government debts of GDPs. The first to fall is, of course, those who are having 20% debts to GDP. Actually, sorry, it's no, it's about 80, 100% for these countries. So Ethiopia is around 50%, El Salvador, Tunisia, Pakistan, Ghana, borrowing 80% no of their GDP gross government debt. The Philippines isn't falling much, no, but Philippines is somewhere here at 60. So we're also in elevated debt levels. The world's economic top policymakers are already sounding the alarm. Years of living dangerously. So you've got all these risks continuing. Oil price still at $120. Global food inflation rate, depending on which country you're in, some are 20%, some are 10%, 15%. But the point is that it's really high year on year. Overall, emerging market spreads are already sharply pricing in too much of the risk, and countries in debt distress are growing double, triple. So far, debt distress, bonds trading more than 1,000 basis points above U.S. Treasuries. That means that a lot of countries are being priced in for default. For this country, Colombo, the country's currency down nearly 40% this year. Good thing the Philippine hasn't devalued as much, but the Philippine currency has already devalued from 50 peso to 53 peso. That's about 6% devaluation for the year. It's going to be harder to have to service all the foreign debt payments. Other countries are down nearly 40%. They can't even pay for food and energy imports. So for people in Colombo, like Jagat Gunasena, sending his wife and son to just to stand hours to refill a cooking gas cylinder just for a Colombo food stall. At least we have leftovers from our food stall to eat. I don't know how others find ways to cook or get by. Um, there's a lot of countries asking help already from IMF and Asian powers like China and India. Let's take a look at the biggest risks that are probably a contagion after the vulnerability on this shortage, this war in Ukraine, Russia and Ukraine. You're seeing the following. So Turkey, Egypt, Vietnam, the Philippines is ranked number 4. Poland is ranked number 5. South Korea is number 6. Thailand's number 7. We're overall getting a difficulty, of course, in our imports because a percentage of our GDP, as you could see, for the Philippines and Vietnam, 3.6%, we are negative. So we're not exporting, we are importing. Only Saudi Arabia is relatively safe. Net grain exports also very difficult. So that means we are all negative. That means all of these countries are importers. Trade and investment exposure to Russia, almost all countries here, but most especially Turkey and Poland. So a lot of exposure to Russia, which really is going to be very difficult for countries in terms of vulnerability. All right. So far, these debts are a doom loop, which could return to 1997-1998 crisis. We've seen Russia and Argentina fall into defaults during that time. For those who aren't aware, during 1997, the Philippines was part of the ASEAN crisis. We remember that time when the dollar peso actually devalued quite sharply. I think that was a time when 1997 crisis, we saw the dollar peso, I think, sharply devalued somewhere from 26 to 40 pesos. But you can check the charts just to see what exactly happened. But this was all throughout Southeast Asia. So it was also known as the Asian financial crisis. So the increase in borrowing costs is getting steeper. So we've got all the rules for the BRIC nations to have difficulty. Jim O'Neill, the Goldman Sachs economist who termed Brazil, Russia, India, China as the BRICS, is saying that this inflation risk is going to be a disaster for emerging markets. So we are seeing just last night, Brazil companies like Pags and StoneCo dropping 15% and 25%. US firms like Square, Affirm, a lot of these buy now, pay later, getting a huge drops of 10%. Not just because Apple is in the game of the buy now, pay later industry, which was introduced on Monday, but I think it really has to do with the servicing of debt, where people believe that these creditors, i.e., consumers, will have massive credit card defaults, or a lot of bank related securities are all gonna default. So you're seeing massive drops on fintech, which have been already dropping 70-80% already year on year. So you're just seeing a catastrophe furthermore. Jamie Dimon, which is, of course, the JP Morgan CEO, said that the Fed, however, has no choice but to do quantitative tightening. And he doesn't know how the markets would react, except that prepare for all the possibilities. Obviously, we aren't just in a storm. People like to say, brace for a storm. What he thinks is that you have to brace for an economic hurricane. So if all these catalysts are telling you to sell and go to cash or short, um, your guess is as good as mine. But I would be more confident leaning on the short side. And if you have longs in the market, make sure that the exposure is small enough. It is gonna be a hard time. Others would argue that the recession is gonna be mild. It's gonna be a soft landing. But we'll see in the charts. Let me show you the charts in some news. This was a snapshot of Druckenmiller. Stanley Druckenmiller is the protege of George Soros. You could see that Druckenmiller on inflation, all the signs in his studies point to a hard landing. And so his portfolio positioning is shorting bonds, shorting stocks. He's just setting out currency so far. He does own some commodities like oil. Nothing much, nothing big. He says that he's not aggressively short, as he knows that bear markets are, of course, known for face-ripping rallies. Nonetheless, you could see that the market, if it rallies, has tons of people in the sidelines looking more to short. Lots of news. Bringing down inflation is going to take time, patience, and pain. The Dow Jones dropped more than 600 points ahead of the pivotal inflation data. David Einhorn, one of the big hedge funds out there, says the Fed is bluffing, doesn't have the tools to squash this inflation. CFOs are saying there's a recession hitting the first half of 2023, and the Dow is headed lower. So you've got a lot of people obviously short. Just more news. Inflation, frustration, power, fuel, and food all rising at double-digit rates. So you're seeing that 20, 30, 50% moves depending on what product. No? So electricity, utilities, gasoline, food, everyone is getting hit. So obviously the consumer discretionary spending is going to be curtailed, whether that be a vacation to Bahamas or even a vacation to Disneyland. So it's obvious that people are shorting Airbnb. Americans are living in day to day. So gas prices, $5 per gallon, grocery prices, even Walmart and Target are being shorted. The CPI report is forecast to show annual inflation rising to this month. We're going to get that expectation of 8%. Thing is, even if inflation is 8 or 9 or 7 or 10, whatever it may be, the market is obviously bracing in for the worst. So you should still expect some sellers on any rally before the markets or after the markets, even after the markets. So obviously everyone's getting a rough time. You're seeing this clip wherein it's a little rough. Annie Tris Jackson, 59-year-old health specialist in Miami, says that her May utility bill was $234, up from just $100 last month. She's purchasing less seafood, less meat. She's reducing her car insurance coverages, canceling August vacation to Disney World. With bills so uncharacteristically high, a lot of the things we used to do, we cannot do. Basically, say goodbye to consumer discretionary spending. That's going to affect companies like Nike, companies like Tesla, companies like Apple, Lululemon. So there's really a huge problem where the question now is, has it been priced in, all of these negativities? Because most of these are also known by the market and is being priced in going forward. But let's just go through a lot of these articles. More families are going without. 31% of households are having difficulty just to pay for their usual household expenses. So this is also affecting your consumer staples, whether it be Kroger, Walmart, Target, Procter& and Gamble, Unilever, Coca-Cola, Hershey's, McDonald's. Even those things are getting affected with this recession. 9% of households don't even have enough to eat. So that means more poverty. In the Philippines, you've got Rizon trying to aim to supply enough clean energy, but this is 2026 to 2027. Those are far off to contain all the necessary energy that we need today. The facility, which will be supplying 850 megawatts to Manila Electric Company, the Philippines' biggest power retailer, it's available only in 2026 and 2027. So good for Razon to be investing in clean energy. However, to displace all the coal and liters of oil this year, it's not going to happen. So it's going to be a harder time. With the consumer discretionary spending already in the rocks, you're already seeing Chinese companies like NIO, the EV, Tesla killer, supposedly reporting a really huge loss. You're getting losses of about $280 million this quarter, on pace for a 4x loss. You're seeing from $70 million to $280 million. And of course, this has been hampered by the COVID shutdowns. So that's really going to be a difficulty for NEO. We have plans to short NEO, and we are shorting it on this rally. Let's just read through all the news. From News first quarter earnings report, revenue is $1.5 billion. The losses have quadrupled from 4 cents to 13 cents. Gross margin is now 14% with rising costs all throughout on commodities, lithium, nickel, copper. NEO shares are down 9%. Investors are digesting the decline in gross margin. Rising commodities have continued to squeeze the margins. And even with EV subsidies, that's just a band-aid over the entire wound happening in the consumer discretionary sector. So we believe that NEO knows your stop. So I think that everyone in the world, obviously, if you're shorting here at about $160, everybody knows that maybe your stop loss is here at about 170. So I would rather that you short from 160 to $190 or somewhere from 22 to 26. That doesn't change the fact that these are resistances. So may chance pa rin. We're also trying to short NEO through put options. We are still waiting for the opportunistic low risk time to short NEO because there's a fundamental discrepancy between what the stock prices are showing, which has rallied from 100 to 160 or even 200. There's a massive fundamental problem here versus what the stock price is showing. A few things to also note about, if people are not spending on consumer discretionary, one thing to also watch out for in Hong Kong and China is Haidilao, which is the hot pot. You're seeing a huge sell-off because people are less willing to obviously spend or dine out. So $17, $16, no change in view. This isn't just about Haidilao. This has to do with all consumer discretionary, fast food, casual dining restaurants. That goes for restaurant industry in general. So it's really a hard time, in my view, for tourism, for hotel leisure, for casual dining restaurants. Haidilao, Cheesecake, no change in view. Chipotle, there still sells. Now, Alibaba was rising last night, but it was quickly squashed down. The shares went as high as 123, only to sell off at $108. Right now, pre-markets, I think Alibaba's trading at 113, 5% rally. The rallies, in our view, are to be shorted. There have been news that it's a possibility for China government and the regulators to revive the IPO of Ant Group. But in my view, with the market sour on all the IPOs, even an Ant Group listing perhaps isn't gonna revive the sentiment. So I think all the good news happening in China is premeditated and it's meant for short covering. But you can see that the world overall is skeptic of all these positive news headlines. And in fact, this is just another sell-off in the making. You're seeing listed Chinese stocks falling down. Nasdaq Golden China Index down last night, 7%, snapping the rallies. NEO and Bilibili obviously had bad numbers. Neo dropping 8%. Billy was down 15%. Although now Billy can be rising 7%. All of these volatility are part and parcel of what a bear market is. A bear market usually has down 20%, up 20%, but it doesn't change the fact that your primary trends are still down. Take note that if you go down 15% and go up 15%, you are still downtrend. Just do your math. Let's say 100 fell 20%, 100 went to 80, 80 went up 20%, that's 96. So 100 versus 96 is still down. So your primary downtrend in Hong Kong and Chinese stocks continue to remain in place. Restaurant operator Yum China, that's KFC, lost 8% just on the whiff that China might actually lock down yet again. If China locks down yet again, that impacts Tesla, which is Shanghai Gigafactory. So that's gonna be very difficult. Some people are even saying that the restart of Ant's IPO is too good to be true. There's a lot of questions on the political side and a lot of patience is needed. What you can see here is that the market is heavily damaged. You cannot actually go from bear market to bull market without 6 months, 10 months, 12 months, 18 months. It's not gonna be a long, it's gonna be a long, drowsy market wherein you get bouts of rallies, 2 weeks, 3 weeks, and then sharp sell-offs, and then maybe a rally, but still it's gonna take a long while. So this has been the news. COVID flares anew in Shanghai, sending some back to lockdown. We think that the risk reward is still on the downside, and we are positioning our portfolios mostly shorting Chinese shares because Chinese shares have rallied quite significantly. Whether you're just shorting a Yum China or a Haidi Lao, or you're shorting something like a Trip.com, which is really about the Airbnbs of China. Trip.com is like the Airbnb of China. Think that every consumer, not just in America or not just in emerging markets, are having a hard time. You're seeing China's COVID-0 approach, taking hard line on any cases. There's going to be mass testing yet again. We took this snapshot to tell you that hard times continue. No, so Druckenmiller warns the bear market has lots of ways to run as the Fed hikes rates. You can argue that the market already knows that we're going to have rate hikes on June and July. But what about September? What about October and November? There's still potentially a lot of question marks in the market. So even the people who are short aren't actually racing off to buy the market. So we could just drift down, not because of a new news, but just because there's lack of buyers. The buyers aren't rushing to the gates to buy stocks. There's no FOMO. Some stocks continue to be languishing low, cheap valuations. You could argue Chinese is historically cheap. A lot of US names are also historically cheap, but that doesn't prevent them to continue being cheap for the next 6 months. So let's read through a few of the comments of these more experienced investors. Druckenmiller, who managed money for George Soros for more than a decade, now 68, he says that a lot of assets that were purchased during that period that a lot of people moving out the risk curve will lose a lot of money on. That's incredibly costly. It was echoed as well by David Einhorn, Greenlight Capital, in the Irason conference. They talked about the underinvestment in cement, housing, mining, oil, paper. Basically, what they're showing you is that they're very much seeing that the underinvestment on energy has led to this super commodity boom in oil, copper, all these commodities. So it makes sense why they have exited shares. Like for Duquesne, they exited Google, Airbnb, Carvana. They've added more towards oil companies like Chevron. And they're not comfortable in owning bonds either with rising interest rates. So you're seeing them just holding cash, or even if they're holding some stocks, it's mostly shorting stocks. Treasury yields are so much lower than inflation, so that means that bonds will not even hold up in a downturn. That means that if bonds are just giving 3-4%, it's not gonna be enough to tame inflation. So bonds would have to go down further, i.e. go 7-8% yields. For bonds to keep on giving 7-8-9-10% yields, some bonds might actually default because some companies might not be able to service debt that huge as well, or even borrow in a fixed income market that wants to beat inflation, which is trading 7-8%. So he says here, I've lived through enough bear markets that if you get aggressive in a bear market on the short side, you can get your head ripped off in rally. So just because they are bearish doesn't mean that they are fully short the market. However, if there is an opportunity, of course, they said that they would rather short stocks yet again. A few names that we are seeing on a big short side so far has been the shipping stocks lately. So other than China, shipping stocks are giving quite a good risk reward. I even today I shorted Orient Overseas, which opened about 235 to 36 today. So we are seeing that huge sell off partly because container demand shipping are falling down, and even the people are now showing signs of recession. So less people buying commodities as well. So yun, drops na kagad on shipping. Lots of negative news that it's really gonna be a hard time, guys. So I think I spent the first 30 minutes, just really sharing to you the backdrop of the market. But over the next few weeks, no, what you should probably look at is also the charts. So let's go through the charts. Okay, let's go through just a quick view of the charts on the indices and on China, the ones that we've discussed over the last 30 minutes. Quickly now, let me share my screen. Here. All right, so let me share my screen here. All right, so you're seeing this one. This is the TQQQ, or the index. Unfortunately, before the data has been released, you're already seeing the market has been selling off from $33 to $30. And with the loud, loudness of all the bears shorting the market and the lack of willing, confident buyers, unfortunately, the downtrend still remains in play. So what am I doing with my TQQQs? I've been stopped out. Today, I'll be closing my TQQ longs. Admittedly, I thought that this could still rally towards 36. However, I'm wrong, so no choice but to exit first, even at 29.90 or $30.20. So exiting there. As to how low it goes, of course, if it's gap down, I wouldn't be exiting at 25. But if it's just closing here at 29 or 30 or 31, I still believe that there's still a chance to exit first and ask questions later. TQQQ might fall $25 or even worse, so we might as well be careful and exit. So obviously, the drop of TQQQ has led to a strong surge on your SQQQ. Some people believe that they should be buying SQQQ at $40. However, the market is the market, and the market decided to break above 48 immediately last night, closing at 51. A further downtrend in the markets would mean that your SQQQ will then break 52 to land back to 60 to $62, which is somewhere at TQQQ 25. Be careful for those who have TQQQ longs. I think that the bears are still dominating the market tape, and with very few buyers. You have to be of the view that the market's bears are stronger than the market's bulls. If you don't want to be shorting the market, I'd say that stay in cash, because unfortunately there is leeway for further falls. So I've been asked on companies like Square. We wanted Square. You can see those buys. However, last night after that 9% drop, it looks like the bears have consequently stopped out all the traders. And if you are a trader, however, the bearish side last night would have stopped you out. So unfortunately, the break of $80 of SQ, which is Square or Block, is enough to trigger the momentum to short it yet again to 65. So in case you want to be safe, and my idea is better safe than sorry, am I gonna cut my Square? Unfortunately, I'm of the view that later on, after the date on CPI 8:30 p.m., my first opinion is to sell first and ask questions later, and hopefully I'll just be back on Square, say 65 or below it. Unfortunately, I think that the right answer is cut losses, just move on from the losses, even if you believe in the stock long term. So it really depends on you. Maybe in your long term portfolio, you'd hold it. But for the short term traders, my suggestion is don't change your plan. As a trader, you got stopped out. Unfortunately, that means getting stopped out here at $80. So if you have to exit at 77 or 76, just take the loss and move on. And we can just return when the markets are showing to us that it's safe to go again. No, so really, there's a time and place to go long, and nowadays it's still not okay. Square going down. We're seeing Zillow also break down last night. Unfortunately, that means I have to cut. So you're seeing that I was buying these companies like Zillow and Square. Unfortunately, last night, that means that I had to cut. Where will it fall? Maybe at 32. So before it goes further gap downs, I'm gonna just follow my plan, and I hope that you guys also follow your plans. Which is, if you're wrong, you don't stay wrong. If you're wrong, you exit and then just call it a day, and then call it a night, whatever your time zones are. So unfortunately, trading wise, the short term looks very bearish, and it looks like housing mortgage rates, which are impacting the rental and purchases of homes, are obviously continuing to fall. Note though that even as Zillow has been falling down for over a year, the sellers have still not stopped selling off. That means that bargain hunting is the riskiest exercise indeed. And you could see that the bargains are still going to be cheaper bargains. So exit first. That would be the best way. We have to trade knowing what's happening here. It just broke 39 and 38. Could go 35 or 32. Let's just exit and then watch how things play out. When you exit, do you short them? Well, if you see that the resistance nowadays is 41, 42, if the next few days continue to be bearish, then obviously this would still be shorted by the market. So a lot of negativity. Let's go through the extended hours move. So you're seeing Square continue to trade below 80. That is still a sell. The market is still sharing its viewpoint, and we cannot argue with the market. No, the market is saying, okay, just exit further. No support seen on fintech. You're seeing fintech continue to drop. Amongst the shorts, I prefer really shorting cryptocurrencies, as crypto is stubborn and crypto continues to trade high. No, so I'd rather be shorting Silvergate, Coinbase. So I'm just choosing which entities to short, and I would prefer to short MicroStrategy, Coinbase, and Silvergate. Yeah, so it just depends on you. There's a lot of questions as well. You know that we've been bullish on uranium. What exactly do I do after that big drop? Unfortunately, it has to do with exposure. While the market, of course, is underinvested in clean energy, which is why we have this energy crisis in the first place, I do believe that money, end of the day, has to go towards nuclear projects. And Biden has been quite aggressive in saying that they will be sourcing a lot of uranium from US uranium producers, energy fuels being that part. So what I'm doing is I'll exit my Square, I'll exit my Zillow. I'm also gonna exit a few of my Fords. Unfortunately, Ford also is dropping here. I've been trying to go long, exiting some of these longs and possibly just going for my high conviction long, which isn't also immune, by the way. I could see 640 drop 8% or 10% tonight back to 550 or $5. That isn't off my ideas. Of course, you have to be open to all possibilities. And even if you are bullish in the secular trend of clean energy, it doesn't stop the bears from actually shorting it, knowing that the market would face higher interest rates going forward and less liquidity going forward towards the stock market. So be careful even if you're long. I think that what you should properly do in your portfolio is be small in your longs, or if you're long, make sure that you have some hedges in place. A particular hedge that we always do is just going long some inverse funds. FAS continues to be an inverse fund long that I will be happy to load up in. So while I exit my TQQQs and close that at a loss, most likely I'll look at FAS for a buy tonight, even as it's trading at 24.7. I'm looking to buy more of these as the banks would have a harder time when credit cards and loans get defaults, right? It's going to affect finance as well. mortgages having a problem paying, so that will affect your financials. So I'm a bear on financials and I would continue to go long the FAS. This one continues to be a buy for me. I'm also gonna be a little bit bearish on consumer discretionary. There's several ways of being short consumer discretionary. For Lululemon, that could be a good short here at about $300. We're looking at Tapestry, Kate Spade. They sell shoes and bags. My view is that if the current market conditions are bearish, these could be potential shorts in the making. So Tapestry, maybe Steve Madden or shoes. It has rallied so far and looking to be on the short side for these types of retailers. So I'm looking to be on the short side for the retail segment. So you've got these ones. Walmart, I think that the bears are intact. So you can see that gap down continuing to fall further. Target continues to be on the downside. For those who are shorting the consumer staples, your XLP, looks like the bears are still intact. You're seeing that after the breakdown, it continues to fall further. So these continue to be on the sell side. So XLP is still a sell. Consumer staples getting hit right in the deck, uppercut. Might as well short those names. Does it mean that you should be mostly in the long side on the bear side? Sorry, should you be in the big bear camp? It really depends on you, but I think from a trading standpoint, um, we have no choice but to follow our charts, right? So as a trader, we can clearly see that the bears are winning. So if you are long, no matter how long you are thinking or how what your time frames are, I'm pretty sure you're stopped out. So we're showing you just the path of least resistance, which is on the downside. Shippers are being sold down. So GNK, short that. You've got shippers being massively sold off. You're getting that recession vibe. So even the shippers now are getting demand volumes go down. So GNK is a sell. SBLK has now turned south. So these are becoming shorts already. ZIM is also being shorted. So that is now a big short. So you're seeing that a huge uptrend now becoming huge downtrends. So we are reversing. You're like a car, right? So you're turning left and then you're turning right. When the market is telling you to go short, you don't question. You just go short. That's really how things are. We're seeing short ideas happen now. So going short, no, short to Zim. Looking at some meme stocks here, meme stocks don't have any signs of strength as well, so looking to go down. Although I won't short AMC and GME for the reason that their short ratios are obviously bad. No, their short interest is quite bad. So yun. But we're seeing already this bearish movement even on the meme stock. So we're probably gonna see this rally get sold off now. With the with the with the houses also falling down, seeing, yeah, some people are probably gonna sell these names, Lennar, KB Homes, no. So we're seeing the same short ideas. Let's take a look at consumer discretionary, Expedia being shorted there. There, oh, you're seeing shorts on Expedia, Booking being shorted right there. Oh, Booking being shorted. You've got Airbnb getting shorted. So it's just a short galore, guys. So I think that I've said enough bearishness for you, and you're probably bearish as well. I don't want to sugarcoat the tape. Stay safe out there. The market is looking to tank. Staying safe means having cash and probably loading up on some inverse funds. So that's all I could say, and let's see how things play out. But with the way the markets are already set up, it seems that no amount of good news is gonna alter this state. So if you cannot actually have any good news, you might as well just join the party and keep short. Okay, thank you very much, guys, and good night. Bye bye.